Hello, this is Eric Boyce, CEO, Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for March 12th of 2023. Please see our disclaimers for important information. Well, the week that just transpired was certainly a very tumultuous week. Started off with Fed Chair Jerome Powell's comments attesting to the sticky nature of inflation, the fact that they might have to be a little bit more aggressive. Market sold off on that. And then we thought we'd be waiting for a little bit of relatively benign economic data towards the end of the week. And what we got on Thursday was Silicon Valley Bank, SVB Financial. Ticker symbol is SIVB. And so you see here this price action, which is pretty dramatic. I know a lot has been written over the weekend, and circumstances and responses are evolving literally as I speak. But basically, what is Silicon Valley Bank? It's the 16th largest bank in the U.S. As of the end of last year, had a $209 billion in assets, according to the Federal Reserve. And this failure that occurred Friday is the biggest bank failure since we saw the near collapse of the whole financial system back in 2008, and it's second in size only to the crisis era collapse of Washington Mutual. And so, the nature of Silicon Valley Bank and their business is different, right? It is different. So they catered mainly to startups and venture capital and private equity investors that funded them. They had deposits of venture funding from the venture capitalists and those investors into these companies. And so obviously that's very disruptive from a payroll standpoint, operational standpoint, so on and so forth. If you have a bank closure, well, the good news is right now, as of this weekend, it does appear that there's a plan in work with both the Fed, the Treasury, and especially the FDIC in concert work together to backstop these deposits. Now, there's another financial institution that here on Sunday was closed by New York banking regulators, Signature Bank, which catered primarily to cryptocurrencies. And so what was really important in recent action is the fact that these two institutions were designated as systemically important. And so that gives the regulators much broader license to backstop deposits as opposed to just providing some type of backstop for the first 250,000 of deposits per account that have FDIC insurance. Well, obviously, this is important to the confidence of the entire banking sector, and anybody who's been through 2008, as I did, knows the importance that confidence, reassuring, confidence can be. But basically, the problems of SVB Financial are perhaps a little bit unique now, because I'm going to argue very strenuously that the banking sector financial condition is a lot better than it was in 2008. Rules and regulations put into place to make banks retain additional capital, those have actually worked, and we've been through many rounds of stress testing the system where these banks have come through very clear. Now, in SVB's case, honestly, I do think that regulators should have plucked this out because basically it's very tech centric, and so you've got a lot of venture capitalists and private equity firms that have accounts on deposit that are lending their portfolio companies, and all those deposits are being held at Silicon Valley Bank. Well, they were taking these deposits and buying mortgage-backed securities and longer-dated treasuries. And as we all know, interest rates moved up dramatically last year. And when interest rates move up, the value of your longer-term bond holdings goes down. This is exactly what happened in bond returns last year. So Silicon Valley had negative performance on their fixed income portfolio. And you think about a bank's balance sheet. So their deposits are liabilities. and their assets are the loans that they make with the deposits that they get. Well, what happened in Silicon Valley's case is that with interest rates moving higher, valuations getting a little bit out of whack, the tech sector kind of shut down a little bit, and we've had a downturn in activity. And so the portfolio companies that were being funded, they were drawing money out. So no money was being put back in. So deposits were going down. Then the value of the bond holdings that Silicon Valley had invested with those deposits, the value went down, and at the same time there was less activity and worse performance on the other side of the balance sheet. And so here is this situation that we have now where the bank has failed and is now being backstopped by regulators. So that is kind of in a nutshell what's going on with Silicon Valley Bank. For all of you who are interested, I would just hazard that there has been a sell-off in some of the other banking areas and some of the regional banks, but I would say, two things on that. One, I fully anticipate that the regulators are now, in the wake of this, going to do another stress test of all the banks. So we'll get that coming down the pike. And two, the nature of the balance sheet for most other banks is not nearly as tech-centric as Silicon Valley was. Now, we know that the tech sector has just been bullied around with this with the evolution in our economy over the last 18 months. And so, I don't want to draw a parallel to 2008. I think, SVB Financial is, I think, a somewhat isolated case. But again, these things can spread like wildfire. And so I think it's very important here at the beginning of this coming week that the Fed get out in front of this with a confidence statement with the FDIC as well as Treasury, and making people reassured that, listen, the financial system is sound. And this is just a bank that was not profligate, but just a little bit reckless in its balance sheet management. And here's a quick look at Silicon Valley shares when they were halted March 9th. We got that word that they were in a bit of trouble, and then the shares were halted on Friday when we learned of the closure and the fact that Silicon Valley at that moment was going into receivership by the FDIC. Here you see the lineup of the assets at the time of failure, just as I mentioned in my opening remarks. Silicon Valley, number 2 behind Washington Mutual. So here's what I want to show you, kind of going back to my thoughts on the entire banking system as a whole. You see deposits are still really high. Loan to deposit ratios, again, if you look at bank liquidity, if you look at bank strength, loan to deposit ratios, I mean, there's abundant liquidity here. Those ratios are not nearly as high as they were back in 2008. So financial sector is in really good shape. So I think it's important to get that message of confidence out, and I think people will realize that this is a somewhat isolated case. So we'll talk about moving on here from Silicon Valley. We got 30-year fixed mortgage rates. You can see where they are now. Forecast is that they do go down when we do have a decline in overall interest rates, although I think the visibility for that now has kind of been pushed out a little bit based on Fed Chairman Powell's comments last week. Do believe that the peak in short-term rates is probably going to be at least 5.5%. We'll get several more 25 basis point increases. I don't think we're going to get a 50 basis point increase in that next meeting, simply because of what happened at the end of last week with Silicon Valley Bank. And I think the Fed wants to tread a little bit carefully on that front. So, but as this chart shows, there is fully an expectation of mortgage rates going down. However, the affordability issue right now is certainly less advantageous. Here's Fed tightening cycles. You can see in that amber line is 2022. The aggressive nature of this tightening cycle. I think This chart speaks very well to essentially what happened in the investment markets last year. These rates moved up at an enormously rapid clip, much more rapid than we have seen in prior tightening cycles, and notwithstanding that, much faster than the market ever expected. And so that resulted in that cataclysm of unfortunate circumstances for the investment markets to post their worst return that we've seen overall since in bonds and stocks together since 1969. Here's interest expense on the public debt outstanding, U.S. Treasuries. You can see here that that's moving higher and has been moving higher with these interest rate increases. The nature of Treasury debt, the government has obviously been taking advantage of low rates for a while, but that's going to change. And I think you're going to see over the coming decade that as a percent of the total budget, you're going to see almost a near doubling of the interest burden on the U.S. government based on higher interest rates. I need to talk about labor for a minute. Average hourly earnings continue to trend down a little bit. Favorable data, a little bit sticky. I'd say this is a rate of change month over month. So, this data can be a little volatile, but the last couple of readings have actually been reasonably decent. So, again, as you look at the inputs into inflation, rents, wages are usually pretty sticky. You like to see a little bit of deceleration and momentum on the wage side because, we're a service-based economy, and so labor matters extremely much in terms of how overall inflation is influenced. And so it's good to see this moving down a little bit. Here's a quick look at ADP, private non-farm employment. This has been down for several months in a row. For small firms. And again, that represents the overwhelming majority of businesses in America. So, I mean, you see this contraction literally playing out before our eyes. So, hiring intentions are low. You've got employment levels in aggregate that are lower for small business firms. And I think this is a real strong barometer for this slowdown that even though there are aspects of the labor economy that are exceptionally strong, here's anecdotally a sign that there is some slowing in the economy that the Fed's trying to generate. Here's job openings. You see that number is still relatively high. So it's come off its peak, but it's kind of jockeyed around. And so, we're obviously running at levels that are exceptionally well above pre-pandemic levels. And so these levels really have to come down. I think when you look at the pace of interest rate increases, I mean, this is something that frustrates the Fed, that they would like to see this come down a little bit faster. Here's our labor force participation rate. We've talked about this before. Participation rates are sticky. They remain below pre-pandemic levels. You have parts of the workforce that have gone away that really aren't coming back. And what the chart on the right tells you is that where that is coming from is in that over 55 plus crowd. Those people that are closer to quote unquote retirement anyway are the ones that have really left this workforce and that aren't coming back. And so 25 to 54 years old represents kind of that slipstream. I mean, those are your peak wage earning years. And you can see that those numbers are actually back up to pre-pandemic. So when you look at employment to population, you do have this favorable data from the labor side, even though your overall participation is not what it used to be. Here's job openings to unemployment. And so basically what this tells you is that there is still 1.9 jobs for every unemployed person in America. Most of these jobs are in the service and trade area, kind of the low and semi-skilled areas. You've actually seen a lot of job cuts in the skilled areas, particularly with tech and some of these larger firms of very notable layoffs from the Challenger Gray survey. But when you look at the overall health of the economy, this is certainly not something that you'd see if you're on the eve of recession. Here's job openings in construction. So, as I say often, with every put there seems to be a take, and this is definitely one of those where construction. Obviously, we've seen a curtailment in building activity in some areas of single family residential, and we see multifamily beginning to slow down. Multifamily was super hot last year, but that's slowing down a little bit, and you just see job openings in construction based on the interest rate and affordability backdrop has really come down. Here's a layoff number on the left. Layoffs and discharge rates are still remain below pre-pandemic. So, even though we've had notable layoffs, I mean, in the aggregate, we really haven't seen a lot of these so-called job cuts. The labor market's very, very strong. Quit rate has come off its peak, which I do think is important, but you can see that has been moving up for well over a decade now and got ahead of itself um, after the post-pandemic recovery. But as you can see here, if you draw a trend line back to 2010, we're basically back at it. Well, interesting tidbit from Charlie Bilello here is that we've got cost of a dozen eggs and a pound of bacon from 1980 to 2023. This is probably as good a barometer for inflation as you're going to see. You see this very methodical, slow uptrend in these costs. I mean, this is kind of reflective of kind of that normal food basket of inflation for the CPI. And then you see the spike. So we've gone from $6.80 to $11.63. And really, this is kind of in a microcosm, what has been going on with inflation over the last now about 15 months or so. Here's a quick check-in on consumer credit outstanding, and then you have basically a lending indicator year over year. We're up about 15%. So, again, another one of those things that you talk about. If you think that you're on the eve of recession, you're going to have banks that are going to really starting to tighten credit, and we do see that in the mortgage side for residential lending, but as it relates to consumer and industrial loans and overall lending, the spigot is definitely still open, and we can see that here in this chart. Here's a probability of recession based on the yield curve. And we know that the 2-year yield is above the 10-year yield. At one point here very recently, we saw all of those yields above 4%. But the yield curve being inverted, meaning that short-term rates are above long-term rates, is usually a recession indicator in kind of the traditional sense, and it's been inverted for a while. And so, looking at this as a yardstick in a microcosm away from all of these other things like leading economic indicators, so on and so forth, earnings momentum, so on and so forth. If you look at this in isolation, that would certainly give you the impression that we are close to a recession, even though some of this other economic data tends to very much belie that. Here's the Cleveland Fed. They have an inflation indicator, and this is a CPI year over year number that they put together, and it's actually had a fair amount of predictive power. And right now you can see that they're expecting that number to continue to trend lower, 6.2% expected in the next reading. You see how inflation over the last several months has been a little bit sticky. You go back to June, July, that's really kind of the peak in inflation. You can see that it's come down, and it in some months much more noticeably than others. But this is the issue right now, is we see that inflation number kind of flattening out, and that surprised people in the latest reading. We want to see that trend down lower, and I do think with some slowing in the economy, small business hiring down, some of these other things that I think at least on the second derivative appear to be decelerating, that we're going to get down a little bit more closer to, I think, 5-ish by the end of the year. Well, here we have money supply growth going all the way back to 1870. For those of you who are keeping track, money supply growth is kind of the mother's milk to economic expansion, to credit expansion. People take credit and expand businesses, buy businesses, build businesses, so on and so forth. And so when you have money supply contraction, that is a sure way of slowing your economy. And we've been talking about this a lot. Not very many people are paying nearly as much attention to this as they should. They're focusing solely on interest rates. But when you think about quantitative tightening, how the Fed is taking liquidity out of the system, raising interest rates is certainly one way to do it, but this is the other way. Money supply growth is now negative 2% on a year-over-year basis. I've been talking about this for months now. This is going to be the impetus behind the inflation coming down. Now, the author of this article that I pulled this chart from is trying to, the case that they're trying to make is that, when we've had these instances where we've had negative money supply growth, that we've had, fairly strong economic downturns. And I'm not saying that absolutely can't happen. Our financial sector is in much better shape. Labor is very strong. Corporate balance sheets are in really good shape. So the prospect of a major downturn, I think, is muted. But I think it does correlate well with these other prior times. And again, you've got to go all the way back to the Great Depression to find money supply growth that is negative as it is now on a year-over-year basis. Here's a quick look at the beige book, and it shows us that the market has regained a little bit of momentum, actually, amidst all of this kind of somber conversation about economic slowdown. We have seen a recent uptick as of late. Well, something else that we've been paying attention to has been temporary employment, and usually, it helps to take up the slack in an expanding economy when you are struggling to find workers. Temp help kind of fills that gap, and obviously, when you're in a very tight labor market, you do whatever you can when you have to do it, and so we did see a fairly strong movement in temp help. Which is in this kind of this amber or brownish line here. However, that has really turned over now, and this is year over year, kind of pushed forward 6 months, and then overlaid with total non-farm payrolls, which we know have decelerated, but they're still very, very high on a year over year basis. And so, what this is trying to suggest is that temp help is somewhat of a leading indicator for overall non-farm payrolls to slow down. And I'm not going to argue with it. I think it is symptomatic of what we're going to see. I think it's symptomatic of seeing a higher overall unemployment rate, or at least an increase in claims for new jobless benefits, et cetera, over really the next 3 to 6 months. But again, that's what you'd expect in this environment. This is what the Fed's trying to engineer here. Well, we're going to switch over to the investment markets for a little bit, and this is not on an even scale, nor is it necessarily even on a logarithmic scale. But I think it's really important to kind of get back to, now, not everyone is going to have a 200-year lifespan, right? But this chart goes back to 1871. And just when you get nervous, just when you get upset about the pace of the market and frustrated with the fact that in a given year it's not really doing anything, or it's slightly behind, this goes back to this whole theory that if you just have patience, these things do work themselves out. And you do have secular bear markets followed by secular bull markets. These things last for years, and we've been in a long secular bull, and that's not to say that we're necessarily going into a secular bear. But we clearly, if you look at this long-term trend line, what it's going to tell you is that you are still moving. You're still above that long-term trend line. And, again, I think just to hopefully reassure some folks that, that there is a long-term trend, which is extremely well rehearsed if you can get past a lot of the interim noise. Here's a volatility chart. We see that volatility has picked up in our equity markets rather noticeably here in the first week of March. And here's a busy chart from our friends at Fidelity. This is Yuri and Timmer, and does really great work. And really, if I can distill this into the takeaway points, down in the bottom half of this, you've got in kind of this light blue line, you've got the return differentials for small versus large cap, 10-year compounded annual growth rates. And you can see, he's identified 3 very strong cycles lasting multiple decades here. And what this tells us right now is that, looking at this chart and drawing some inferences from inflation and the cyclically adjusted price to earnings ratio, is that over the next handful of years, decade perhaps, that small caps probably should begin to outpace large caps, and that value, which has underperformed growth, except for most of last year, but if you look at it over a period of many years, that value has underperformed growth, well, that should turn around as well. And that also that we should see better performance out of commodities too. If you look at the long-term implications of these trend lines, which have been well identified going back to 1930. Well, here's a fertilizer price chart that I thought was really interesting. We're back to February 2021 levels in this particular part of the commodity basket. And so, if you're thinking about food costs, fertilizers obviously very strong input into all of that. Obviously was impacted by Russia's invasion of Ukraine, because Russia is a major fertilizer producer. Potash, and then other fertilizers as well. But I think if this trend holds, then we should see some relief in food prices. Here's the S&P earnings yield minus the government 10-year. So this is like basically a yield differential between what you get from equities versus what you get on bonds. And as we know, bond yields and interest rates on interest-bearing components of bonds have been moving higher. And then the earnings yield, which is the inverse of the price to earnings ratio. We know that price to earnings ratio is about 18 times. And so if you take the inverse of that and then you subtract out the bond yield, what you get is where we are now, where it's been trending lower. And when you look at the long-term implications of this, or maybe not the long-term, but the interim implications of this, you want to see that bottom out. And usually when you see that bottom out and trough, that the next several years after that are generally pretty good for equities. But I do think this is one of those years in 2023 that equities may have somewhat muted performance, but then you're going to get better performance out of fixed income. And this is a sentiment indicator from JP Morgan asking their clients, are you likely to increase or decrease your equity exposure? And so right now, the percent of those planning to increase equity exposure over the coming days or weeks, and of course that's pretty ambiguous, but I'd say realistically that's maybe over the next 2 to 3 months. Well, that's pretty low right now, about 30%. People are not very optimistic. We've seen bearish sentiment tick up here as of late, and you can see going back to June of 21, which when tech stocks were rocketing higher, and you see that sentiment having really trailed off. Well, on the other side of the coin here, same survey, we have a question about fixed income. And so, this is asking investors of JP Morgan, are you planning to increase or decrease bond portfolio duration over that same time frame? And so it's important to kind of define what duration is. And it really is a measure of price risk for fixed income. And the higher the duration, the more risky, the more potential price risk that you might have with a particular bond given a change in interest rates. You can think of it as kind of a loose, very loose proxy to maturity. So, again, if you're thinking about, risk, generally, if you buy higher duration bonds, you're getting a higher interest rate because ostensibly you're being compensated in that higher rate for the additional risk that you're taking for that duration. And so, here we have a pretty low number of those planning to decrease their bond duration. So these are investors that have longer duration assets that are actually willing to hang on to them now. And so, now that the interest rates have moved higher, it is a little interesting to see because obviously you're making a lot more money on money markets and short-term rates than you have been in many years. Yet you've got a lot of folks that are still out there in duration and taking risk with their bonds now that rates have moved up. I thought this chart was interesting because and it has parallels in other parts of the investment world. When you think about energy, right? I mean, you can buy the exchange traded fund for the energy sector. Well, you get a lot in that, and I think there's a common misperception that if you want energy exposure or if you want exposure to oil prices, you buy the energy sector. Well, that's true, but only to an extent. And so this represents oil and gas sector betas to the price of oil. And what does that mean? That just means that that as oil moves, like take that first one, equipment and service companies, that the publicly traded, the stocks of equipment and service companies, that the relationship between their stock price and the price of oil is positive, but it's not a perfect positive. And so only about not quite 60% of the price movement in stocks in oil services and equipment can be explained by movements in oil price. And then you go to other sectors like refining and marketing and the oil majors, Exxon, Chevron, that you can only explain about 25% of the price movement in those companies by the movements in the price of oil. And so, what that should tell you is that that I think when you're in fluid market environments, that it pays to dig underneath the details and what kind of exposure do you really want? And sometimes you want a sector exposure, you just want to get exposure to it. Sometimes it's worth spending the additional time and research to dig down within those layers to find the best investments. Well, I thought this was interesting from Gabe Kyle research. With all the belly aching and hot air about how we're trying to curb trade with China because of this major, political row that we have with them, it's clear here that certainly, over the last couple of years at least, post-pandemic, that our exports to the U.S. or conversely, our imports from China have really picked up. And lastly, this week, just showing you kind of the somber tone that you have kind of in the average investor world right now after having been dragged through the bloodbath of last year. Here's a Fannie Mae survey. A percent of respondents who expect their personal financial situation to get better is as low as we've seen it since the global financial crisis. So a somber attitude out there. But again, if you go back to that chart that I showed you, that long trend in the equity markets, which in most diversified portfolios is, at least 50 to 60% of your portfolio, that is moving higher on a longer term basis. So, I'd say, these things can be, pretty well influenced by, current news flow. And there's certainly more of that out there with social media. And so sometimes you can be adversely influenced by articles and innuendo that's written without a whole lot of research backing it, and it can have an emotional impact on you. And so, I just go back to long-term investment objectives, long-term financial planning. If you have a horizon that's longer than say 8 to 10 years, and most people do, again, people closer to retirement, you need to be a little bit more careful about these. But the long-term trends are absolutely intact. And if you have a 20 to 30-year horizon, not that you shouldn't be worrying about what's going on right now, but just keep it in perspective that, I realize that there are a lot of people to this chart that they don't expect, fewer people expect their financial condition to get better. But again, that's what effective financial planning is for. Financial planning includes budgeting. It includes, obviously expense management, forecasting expenses on the horizon so you can budget for them better than just, spending out of pocket when they show up. But I think to this chart, and the way we'll close this week, is that there is a really strong value in long-term financial planning, and the value in the diligence to stay with your plan, because those long-term return trends are pretty well intact. Got today. Hope you've enjoyed the chart pack, and hope you have a wonderful week. We'll talk to you again soon.